Good day to one and all. This is Dr. Sivaraman of iknowindices.com. We are on Friday now, 11th of November. I came on 7th of November and gave during that of the Asian session live market analysis and the forecast webinar, the expected market moves during this crucial time of US election. So today we are in the process of reviewing the forecast, what I have given it during this webinar, Asian session live market analysis and the forecast. So as I explained, there will be three components in the trading system. One is the forecast, the session-wise forecast for all 5 days of the week, and also market reading technique using the initial lows and the highs set in the live market code page. This is displayed here. And the third one, namely the trading strategy, using the hedging order to limit the risk and maximize the profit during our either way trades. You can contact me through email dr@i-knowindices.com in case if you want to have further clarifications or any of the forecast, etc. Also, you can use the Skype chat ID iknowindices@hotmail.com to contact me live in order to get the trading solutions. Then my website is iknowindices.com with a hyphen, and that you can use it to get more information about the market forecast. First of all, we will go to the forecast part of it. I was explaining on 7th that 8th the voting is going to start, and 9th the market is expected to make a very big volatile move. So on 8th the voting happened. At that time Euro and GBP are firming up, and on 9th after a brief dip it started rising. When Trump was leading, it started rising. So everybody would have been wondering, so that is going to be the order of the day. But subsequently they started making the drop. And again they made that swing and firm up and then drop yesterday. And it has come to the low set for the week. And now today we are on Friday, and they are expected to make the dip and firm up during that of the Japanese session. And during that of the European session, they are expected to make the swing and slide in order to induce the long holders to liquidate the long positions in all the majors. That is, the buy positions in the case of Euro and GBP, they want them to liquidate, and sell positions in the case of USD, they want them to go in for a short cover. Then later on, they will just swing and firm up during the European session. And then next week, we'll come across from 14th to 18th November, the monthly trending time. So initially to start with big beginning false move, they will make and then make quick rise in Euro and GBP and drop ASDN, telling that there is a risk appetite. There is going to be a good governance. So because of that, there will be a risk appetite in the market, and then a lot of people will come for investments. So the market is known to give the surprise to that of the traders. And in order to reduce the surprise, we go in for the forecast algorithm. And also we do the market reading to fine tune how exactly the surprise will be. And then we try to use it for our trading so that we'll be able to really and quickly book profit during such either way big swings. So in the market, the players are known to make such big swings. And I was telling you, during that of the US presidential election time, the players make very big moves in order to take care of the monetary needs of various people. So that is why they bring in such a volatile move in the market, and thereby many of the institutions and the traders lose money. The big players make very handsome money and then distribute it. So you need to understand that it is a man-made market. So when they are in distress and when they want more money in order to use it for various illegal activities, then they have to necessarily make such big volatile moves. And so they create the market sentiment and act against that of the traders. And invariably they catch the traders unaware. So that is the basic motto of the players. Catch the traders unaware. Let them get trapped. And if they don't use any appropriate trading strategy, they have to lose the money. So when the traders lose the money, even the institutions lose the money when there is a 15% difference from that of the holding position, they are forced to liquidate. The players make such moves in the market so that there is a big calamity, financial calamity happen in the market, and that is being used as a great advantage by that of the players in order to become more wealthier. So such wealthy people think that they can make more money by creating more confusions to that of the markets. So always keep in mind that if the market is not manipulated, technicals and fundamentals will work, and we'll be able to really make nice money following some of the scientific methods. But when the market is manipulated, the players create the market sentiment and pretend as if it is going to follow the technicals. And when the traders commit positions, they act against them, telling some phrases or rumors or whatever it is. And for the volatile move, the big rise on 8th and the 9th, during that of the election time, they gave various attributions to that of the market. But ultimately, everything subsided. It started coming to the same level where it has started. So that is the basic strategy of the players. So they pump in the money, rig the market, and then when the traders become euphoric and they find that it is going to be the uncontrollable rise in the case of Euro and GBP, when the traders go in for a distress short covering, then the players sell it to them and slowly slide and drop the market and induce the long holders who buy after the drop following the technicals. Okay, this could be the support, this could be the support, and they try to buy, average it, and find that the market is falling just like that without any support. So this is the main issue we need to understand if you want to be a trader for a longer time. If you want to be a trader for a short duration and say that finally I come to the conclusion that technicals and fundamentals do not work, and that is of no use because you only trusted it, and subsequently you only say that it is not working. By that, nobody is affected excepting you, because you followed it, you trusted it, and finally bet the money following it, and later on lost the money and simply say that market is crazy. And every year you come across new traders come with the same objective of entering into the market, following technicals and fundamentals, will be able to really make big money. And later on they find that all their savings are liquidated and they are being taken away in the form of loss. And later on they think that it is not a good place to survive. Then they go for alternative method of earning. So when you want the quick money to come, then the players try to trigger your emotions. So easily they can trap the emotional traders. So if you want to become a sane trader, first of all, you should have that mechanism to control your emotions. The emotion is being triggered because of over trading. When you commit too many positions, when the market make quick up and down moves, you do not know what to do with so many positions, because one position will be in the money, another position will be away from that. As a result, you will find that you are not able to really make good fortune out of that. At that time, you find that you continue to hold the position for a longer time, then come to the impression that holding the position with the hedged condition is of no use, and distressfully close all the positions and start hitting against the computer, etc. So ultimately, when you become overstretched, then your mind is not in a position to think properly. When it is under the grip of emotions, it fails to think. Then it requires a guru to guide you. So ultimately, what is the prime important thing for a trader is be patient, and market rewards patience and not impulsiveness. Besides, you should also objectively think that in the market there are two possibilities. One, the traders who can take buy and sell position. Another trader taking the sell and buy positions. Both continue to trade in the market, but ultimately some lose and some gain. And one time the buyers might be earning money, other time the sellers might be earning money. But if you use the hedging, you act as a buyer when that fortune is on that side. You act as a seller when the fortune is on the other side. So that you'll be able to earn really on either way trades or either way moves of the market. So keep in mind that you have to be an objective trader, and only then you will be able to really make good money from that other market. And for that, I am giving, without expecting anything from you, the forecast, session-wise forecast on all the weeks. Besides, I also tell you how to go about in doing the market reading by yourself, so that once you understand how the market is being manipulated session-wise and how the forecast is able to help you in understanding the decision of making a trade within the session, a swing trade within the session, then you find that trading is really rewarding. So try to control your emotions, try to learn the art of trading. Then you find that consistently you can earn money from that other market and make it as a living. Now coming to that of the initial lows, coming to that of the lows and the highs which are to be set for the week. I gave it on Monday, the levels, and now you can just compare it and find out where exactly the market is. Now in the case of Euro, they expected low as 1.09. They came down to 1.0865 yesterday and started gaining the level to 1.09. It went up to 1.13 level on 9th during the European session once the results are out. So they just made the swing in this particular range. This is mathematically derived range following the limitations of the players. So you have to keep it in mind. It is not simply speculation. It is based on the limitations set for the players. So if you follow these levels, you'll be able to really take appropriate decision for a swing trade or a position trade. Then GBP came down to 1.2355. The expected low was 1.2350, and the expected high was 1.2750, and they had come up to that of 1.2576, and during that of the US session they could breach and go above. So if you watch carefully, GBP they are holding only Euro, they have made that drop in order to drop Euro GBP cross. In the market, I'll explain to you what is currently happening in the market after this. Then in the case of yen, 102.75 was the expected low. They just extended another 150 pips to 101.19 and then quickly gained the level above that of 105.75 to 106.95. So they made really a big move in the market, especially in the case of USD yen, because by making such move as a contrarian move along with that of Euro and GBP as well as against that of Euro and GBP, they made big moves. Then handle the yen crosses also in a big way, because many of the traders think that it is easy to trade yen crosses. If you trade without the hedging of 50 pips, then you will be in great danger because the yen crosses make very big volatile moves. One need to understand the behavior and then commit positions. Simply following the technicals and enter, you will be struck with the positions. Then in the case of CHF, again 96.50 was the expected low. They came down to 95.45 and went up, and 99 was the expected high. Just 3 pips short of that, they went up to 98.97. Then in the case of Canadian dollar, 1.3150 was the expected low, but they came down to 1.3266, and 1.3450 was the expected high, but they went up to 1.3525 and started coming down again. So it is basically an extended upward stop in order to drop later on. Then in the case of Australian dollar, 75.75 was the expected low. They came down to 75.60, and 77.75 was the expected high. They came up to that of 77.72. So now we can understand that how the players make big moves, even though it appears the market can make unlimited move, but there are limitations. If you read the limitations carefully, I have given openly those limitations to you, that in the case of euro, they can just make 150 pips net change level either on the upside or on the downside. And similarly, in the case of GBP, 250 pips on the upside or the downside. In the case of yen, CHF, they can make either on the upside or the downside 200 pips. And in the case of Canadian dollar, also 200 pips swing in a given day. And in the case of Australian dollar, 100 pips in a given day. And similarly, there is a weekly limitation of 350 pips in the case of euro, 600 pips in the case of GBP, then 450 pips in the case of USD and USD CHF, and Canadian dollar and Australian dollar limitation is 300 pips. If you follow these things carefully and identify the momentum the players make in each currency depending upon the volume and also the traders committing positions, then it is very easy for you to mathematically calculate the expected highs and the lows. So it requires a little bit of applications. So simply beating around the same method of analysis is not going to give you a solution. Then we'll come to that other market reading. So it formed the low 1.0875 and they're just holding it. And 1.0924 is the high. They are not breached the low or the high. 10 pips positive net change is seen. In the case of GBP, 1.2526 is the low, 1.26576 is the high. They are not breached the low or the high. And in the case of yen, 106.25 is the low, 106.95 is the 93 is the high. They are not breached the low or the high. 98.45 is the low and 98.79 is the high in the case of CHF. Then 1.3462 was the initial low. They just breached it and came down to 1.3457 and come above that of 1.346. So they are expected to make they have made a brief downward stop and they are expected to go near that of the high, make an upward stop and make either way swings in the case of Canadian dollar. Australian dollar 75.60 is the low and 76.15 is the high. 77.42 is the Thursday high. So still it is not being changed. So keep in mind that the players have not breached the low or the high in all the pairs excepting Canadian dollar. They just brief downward stop in order to gain the level and make upward stop above that of the high. If you look into that of the market, euro is showing, I am just referring to that of the live market code page, euro is showing 11 pips positive net change. GBP is showing 16 pips positive net change. and Australian dollar is showing 6 pips positive net change, all making brief US dollar weakening move. And USD is showing 21 pips negative net change. CHF is showing 6 pips negative net change. Canadian dollar is showing 4 pips negative net change. They are also making nominal USD weakening move. So to start with, all the currencies are showing the USD weakening move. And you know that yesterday and day 4, they made differential moves. And now if you look carefully, GBP they have been holding, and Euro they made the drop in order to drop the Euro GBP cross. And similarly, they gained the level in the case of GBP, gained the level in the case of USD and nominally made the correction to make a net change negative. But because of that, they gained the levels in the case of yen crosses. And you know that Australian dollar and Canadian dollar were making contrarian move when they were making big moves in the market. When Euro went up to 101.13, Canadian dollar went up to 1.35, mainly to handle on the upside Euro Canadian dollar cross. And Australian dollar was dropping from 77 to 75 area at that time. That is Euro Australian dollar. They just made the big rise by dropping denominator Australian dollar, rising Euro. They just made a big rise in the case of Euro Australian dollar, and now they dropped Euro also holding Australian dollar. As a result, Euro Australian dollar has come down. So during such crisis time, many people think that it is better to trade following the technicals, the crosses, and the traders are being vulnerably trapped when the players make such moves, because they know as an inside information that where the traders have committed positions. And if they know where the traders have committed position, then automatically you find that the players act against it of such traders so that they can make a decisive profit from the market. So keep in mind, you have to commit very less position so that you will be able to trade on either side. On either side. Many people say that you trade like a professional. You trade like a professional is when the trade goes wrong, a professional accepts the loss very quickly. And if you try to trade like a professional, what will happen? Invariably, you will be cutting losses on all the positions because they trade with a different strategy, whereas you cannot do that. They are all sometimes the bank dealers and also some of the fund managers. They are all highly impulsive, and they just simply reverse the trade with a big volume and earn and compensate the loss, etc. Which you cannot do that because they have a big volume in their hand, whereas you don't have such equity. So don't simply try to copy somebody who can really make profit, because what is your equity only it is known to you, and how much of risk you can take only you know. Others do not know about it unless and otherwise you disclose openly. In such a situation, trade as if you are a conservative person. Trade as if you don't have much of an equity, so that you consistently follow all the methods without becoming panic and earn money from each and every trade. So never commit more positions and don't go in for averaging trading. I have been telling it for many times. And if you want to go for an average trade, I explained it in my trading system. You can do the average every 150 pips drop or gain in the market, the averaging, so that when you do the sixth average, the market would have moved about 1,500 pips away from your original position. But if you do that, still your equity will be holding. You will not lose the money. And you can use the hedging to limit the risk. and do either way trades without of the hedge at that time. So if the position is hedged, there is no compulsion that you have to exit out of that immediately. You can always wait and wait for the great opportunity when the market is showing somewhere the profit, either on the buy side or on the sell side, and then you can continue your trading. So please understand that trading strategy alone will help you to make money from the other market. It is not the forecast or the market reading or any other technical or fundamental analysis which will be able to give you the profit, because this sort of unexpected quick upward and downward moves are part of the game in the market, because the players know the committed positions of the traders. You and I do not know. After the act only we come to know, oh, the traders were all short. That is why the players have made a big rise. And now after the rise, you realize that, okay, most of the traders have liquidated the short position and turned long. That is why the traders have dropped it. So you understand the type of moves the players are making only after some time. But at the time of making it, you require a forecast. And that can be done by following the false move the players make before the intentional move. That is why during that of the Tracking the Forex Market Together webinar, I always say that follow the type of moves the players make, then you will be able to really make good money. But if you seriously look into it, seriously understand, then you will find trading becomes a child's play. Now the recommended trades which can be done in a demo trading platform for your understanding. You can take a buy in case of Euro 1.0870, 5 pips short of the low what they are set. They are likely to make a brief downward stop, and since they are holding it, and later on they are expected to gain quickly the levels and induce that short sellers to go in for a short covering later on, because when Euro has gone to 1.13, many would have taken the sell and simply waiting and say that I'm in the money, I'm in the money. So it is not the panic trader alone lose money. Even the greedy traders lose money. So they will be selling, I'm in the money, Euro is likely to go to 1.05 at the time I'll book profit. That is what they will look into the chart and happily enjoy their dreams, and suddenly you will find that the players make a one quick upward move, induce them to go in for the quick buying against their sells around 1.11 or 1.1050, etc. So that is how they trap. So if you wait for a longer time, the chances of knife falling your head is greater. So you have to use the trading strategy of using a trailing stop in a profit making position. About 20-30 pips or 75 pips trailing stop is also fine if you are a position trader. So in the event of the market reverse suddenly, your profit will be protected and you can re-enter and book continuous profit. So focus on the trading strategy. Then in the case of GBP, they formed the initial low 1.2526, and many traders would have taken sell positions in the case of GBP, thinking that that is the currency to drop big. So, but the players dropped Euro big and holding GBP. Once they do the short covering, then the players, because that is why they formed the new high today. And once the traders do the short covering in the case of GBP, that it is a wrong bet, they go in for a short cover. Then later on, the players dropped GBP more. At that time, you try to take a buy. And then again towards close, they will gain the levels in a big way during the US session, induce the last minute short coverers to go in for a short, because there are a lot of traders who have taken sell around 1.22, 1.23, etc., thinking that technically GBP could go below 1.20 at that time they can book profit, and such traders will be caught. Then in the case of Australian dollar, you can keep a buy limit at 75.65. You could revisit this and come up. At that time, you can book profit. You can do either way trades if you want. So these are all the new market timings which I explained it on Monday. So after that of the standard time, you find that Japanese session gets over by 7:30 GMT, and 7:30 to 8 is the gap time. 8 to 14 GMT is the European session. 14 to 14:30 is the gap time, and then 14:30 to 21:30 is the US session. 21:30 to 0030 is the gap time before the start of the next day session. So the early and the late sessions, they handle the majors, and the mid sessions, they handle the crosses. Follow it carefully, and commit position is only where the currency has made more than 40 pips spread between the high and the low. Then you'll be able to quickly make swing trades within the same session. So if you got any question, you can ask me. I'll be willing to answer those questions. The question answer window. And I'll come back on 14th and give you the forecast for the next week. Is there any question, please? Don't find the questions coming forward. So anyhow, I'll show the forecast page to start with. Today they are expected to make either way stop-ins on the downside during the late European session and upside during the US session. That is how they will end the week. Either way stop-ins in the market. So during the downward stop-in, you can take a buy. During the upward stop-in, you can book profit. Similarly, on Thursday, during the upward stop-in, you could have taken a sell on Wednesday, and during the downward stop-in, you could have booked a profit. That's how we should do the trades, as the big trades. Okay. These are all the levels in which the currencies have made the swing in this particular week. They are in line with the expectations, excepting yen, wherein they just breached the lows and the highs and extended or widened the swings. These are all the recommended trades for the day. Okay. I take this opportunity to thank FX Trade for the facilities provided to present the webinar. Hope you people are benefited by listening to the forecast and also trying to follow it in our trading, and also try to learn the technique of using the market reading method, and finally focus on the trading strategy, and that is going to help you in making consistent money from the market. It is not the question of education. It is not the question of your position in a company which is going to make you a big trader. Just because you acquired a degree or a certificate from somebody, that is not going to help you. And that can simply give a prefix or give probably an attribute to your name, like putting doctor or putting any other degree besides the name. But ultimately, your skill set and your mental confidence in trading, they are going to make you to make big money. So it is not the question of the age which is important. Simply telling that I am an experienced trader for 16 years, 20 years, that is of no use unless and otherwise you have learned the technique, learned the intricacies of trading. Similarly, it is not the degree which is going to help you. It's not the qualification or any other post you are holding is going to tell you that you are a big trader. What is more important is your understanding the behavior of the market. So it is a man-made market. When men manipulate the market, they do it in a very systematic way within the limitations. So understand the systematic condition, then you find trading becomes a child's play. Wish you all happy trading, happy week, and see you on Monday with a new forecast for the next week. Thank you one and all. Wish you all the best.